Welcome back to Street Smart. Joining us, a former Fed economist who says the Fed should be raising rates now, but isn't likely to do so anytime soon. That leaves investors little choice but to favor U.S. stocks over money markets or bonds paying little or no interest. Ed Yardeni is the founder and president of Yardeni Research. He's a stock market bull with a year-end target of 1,500 for the S&P 500 index. That makes you more bullish than Thomas Lee from J.P. Chase. Interesting because there's so many headwinds right now. I mean, the news here on housing is so depressing. The news in Japan, obviously much worse than expected as far as GDP shrinkage. And then over in Europe, of course, we're just waiting for the dominoes to fall. So why 1,500? Well,
the market's been climbing this wall of worry for the past 2 years plus now. Things looked awful in March of 2009, and there's been lots to worry about ever since. I mean, last year we had some of the same concerns as we have right now. We had the European debt crisis. There's a lot more concerns about a double dip in the United States and around the world than there is right now. And I think the market just has kind of learned that you want to stay focused on earnings. Earnings have been phenomenally strong. The corporations have done a great job of figuring out, here are the challenges, how do we make a lot of money despite the challenges.
So it's a case of, though, really the U.S. being the least, U.S. stocks being the least dirty shirt, right, as far as other assets, because otherwise there's no compelling case earnings must plateau this year, I would assume, after the first quarter.
Well, not necessarily. I mean, you know, and I'm looking at it really on a global basis. I mean, the U.S. stock market is very much tied into global revenues and global earnings. And I think the global economy is still in very good shape. I am a little concerned about the recent, I'm kind of two minds about the recent drop in commodity prices. I like to see it happen because it takes some of the speculative froth out, reduces the inflation risk. But at the same time, I use it as a gauge of the global economy. I think the global economy is still okay. I think earnings are going to be fine.
Speaking of speculative froth, LinkedIn shares jumping from 45 to, at one point, I think $120 today. It reminds me of when I started covering this market back in the beginning of 2000.
Yeah, it reminds me of the late 90s and early 2000s. And when you look at the behavior of that versus Glencore, which is another IPO and much bigger, much more important in many ways.
Huge, right? I mean, that's an $11 billion IPO.
That's a much bigger story.
I think Glencore actually closed little change from its offering price.
Well, talk about deja vu all over again. In the late 90s, early 2000s, nobody cared about commodities. Everybody cared about technology. And stocks doubled in IPOs, and that's what we're seeing right now. So, you know, didn't we play this videotape before? You know, Groundhog Day all over again.
And yet people are lined up to get the stock.
Well, I think you know, anybody who's been in this business for a while, anybody who's been an investor for a long time, recognizes this is probably a possible contrary indicator here.
I should point out, by the way, that these graphs are a little bit misleading because since it's the first day of trading, and this is Glencore trading in London, you don't see where the stock actually sold to the public. So we actually were little change there. It looks like it's coming down.
Yeah.
And LinkedIn looked like didn't show actually as much as the bump that they actually got
huge
today.
Yeah.
One of your premises is that the Fed leaves rates unchanged, although you think the Fed should be raising rates, and you don't think that would be a problem for the markets, right?
I think there's just something inherently wrong with Fed policy keeping interest rates at zero. I mean, they could go to 50 basis points. They could go 1 percentage point, and I don't think they're going to hurt the economy, but they will show some confidence in the economy, which I think is important. Also, I really think it's just wrong that a lot of individual investors who want to get a little bit of a return for their cash without taking much risk can't get anything but anything close to zero.
Savers have no incentive, and yet Goldman Sachs and the big banks continue to get free, easy money.
It's kind of like grandma bailing out Goldman, and that's just not right. Now, the other thing that's happening here is, like, what's the rush to buy a house? Home prices are falling, and if the Fed's telling you that mortgage rates are going to stay here for a long time, take your sweet time, wait for home prices to fall. And if they start raising rates a little bit, it's like, well, you know, maybe we should jump in and buy before mortgage rates go up. That might actually help the economy.
It's a very good point. Ed, thanks so much for joining us. Really appreciate it. Ed Yardeni there from Yardeni Research.